Unemployment expectations have dropped to levels only seen during recessions. US consumers' 1 year unemployment expectations tumbled to about 50 points, the lowest since 2008. This kind of major drop in labor market confidence has only happened a handful of times, going back to the 1970s. And every time, it was followed shortly after by a recession. So is this drop today an early signal of an incoming global recession? Or could this time be different? That's what we'll dig into in this video. If we add non-farm payroll to this chart, we can see that actual employment rates follow expectations really closely. That's especially clear in the lead up to recessions. Look at this dip in 2008, or this one in 2001. Both times, unemployment expectations plummeted, and so did actual non-farm payroll. That's what makes this recent dip here so important. If actual employment follows expectations as closely as it usually has in the past, that would spell a crumbling labor market in the near future. But despite the gloomy expectations and negative news coverage, the labor market doesn't seem so bad when you look at how things stand today. For example, look at the unemployment rate, which currently sits at 4.2%. As you can see, that's quite low historically and within the 4 to 5% range of what's considered full employment, one of the Fed's two key mandates alongside stable prices. So, taken by itself, the current unemployment rate is not really cause for concern. Initial jobless claims seen here are also quite low at around 240,000. This is considered to be a very important leading recession indicator. That means it can signal recession ahead of time. And it's true, if you look at initial jobless claims through history, you can clearly see that it tends to rise pretty rapidly before recessions start, going all the way back to the 1960s. But since jobless claims stabilized after the pandemic, this indicator has been relatively flat and remained quite low. So this supports the view of a strong labor market. And here we have non-farm payroll jobs, which measures jobs added to the economy. In the past, this indicator has tended to fall just as recessions begin. We can clearly see that here in 2008 and also in the lead up to the 2001 recession, and so on through history. But today, there's no concerning dip in this indicator, even though the economy is adding fewer jobs than it was after the pandemic, when the economy was restabilizing. It has remained relatively strong at about the historical average and showed no sign of imminent collapse. As we can see, all key measures of the labor market data show it's actually quite strong. So why is confidence crashing? This chart gives us one possible explanation for the pessimism about the labor market. It shows the amount of negative news coverage people are hearing about economic policy. This huge spike here means that right now, people report hearing more negative coverage on the news about government economic policy than ever. This flood of negative news might be why so many people are pessimistic about the labor market over the next year. Most of the negative news is talking about tariffs, and they do pose a risk to the labor market. That's because tariffs squeeze corporate profit margins, and that tends to lead to layoffs and hiring freezes, hence a weaker labor market. And we do see bank recession probabilities increasing as a result of tariffs as well. JP Morgan recently raised their odds of a recession from 40% to 60%, and Goldman Sachs raised their odds to 45%. All of this plays into poor expectations about the labor market. While the labor market has been strong, it hasn't been going in the right direction. Yes, unemployment is at all-time lows, but it's also been rising. Zoom in here, and you can see that the unemployment rate has gradually been ticking up since hitting a 54-year low of 3.4% in April 2023. A persistent rise in unemployment like this could be seen as a recession signal. Just look at the lead up to the 2008 Great Recession, for example, and you see something very similar. A gradual rise before the economic collapse. In 2001, the same thing. In fact, the recent rise in unemployment has lasted longer than we've ever seen without leading into a recession. And there's another key recession indicator that's flashing red. It's known as the SOM rule. The rule states that when the 3-month average unemployment rate is 0.5% above its 1-year low, the economy is in recession, or one will soon follow. And you can see how reliable it is. Every time the SOM rule has been triggered, a recession has followed within 6 months. In most cases, it's already started. And the SOM rule was triggered again in July 2024, when the 3-month moving average of the unemployment rate was 0.53 percentage points higher than its low in July 2023. But that was over a year ago, and so far, a recession is nowhere to be found. So does the collapse of confidence in the labor market spell an incoming recession, or is this a false alarm? There are genuine reasons to believe a recession could be around the corner. Rising unemployment, negative unemployment expectations, and increased bank recession odds all point to a grim picture. But the labor market appears strong by several key measures, at least for the moment. That's why it's important to keep a close eye on leading statistics like initial jobless claims and non-farm payroll jobs to see if they start to move in a concerning direction and fulfill those negative expectations. At Capital.com, we'll continue to keep you updated on the latest market trends and developments. Thank you for watching.